All right. So standard disclaimer. All right. I'm going to go a little bit through it, but thank you for listening to the Victory Hill presentation. What are we going to cover today, right? We're going to talk about gold, but in gold, I'm going to talk about something called 5 Sigma. All right. And then we're going to talk about something called T1 versus T2. What produces long-term stock winners? All right. And things like, are we in a bubble or not? Rule of 72. Now, most people have heard of it, but do they really know what it means and how to apply it when it comes to investments? Technology, mandatory, super cycle. But what people don't talk about is what's going on in defense spending. All right, I said super cycle. How often do you get double digits and what ultimately works in Wall Street? So let's get the ball rolling. I want to start with our standard disclosure. We are not predicting stocks here at all. We're not recommending any stocks. That's your own personal circumstances where you meet with your financial planner and you do things. And we've always said, be careful with leverage. Right? Leverage can be a double-edged sword. It helps you win a lot, but it also helps you lose a lot there. David mentioned our white papers. Please contact David for our white papers. We produced quite a lot. All right. And recently the SMA one, separately managed accounts. We believe these things are very important, probably more important than even having a fund. All right. Funds are mainly for the fund company. It's easier to operate, but most people want to have their own investments in their own space. When you go to your bank account, like I explained yesterday, your bank account isn't shared with 1,000 people. It's your own bank account. Well, that's essentially what a separately managed account is, your own investment. So think about it that way. We're not predicting the future here, right? Our process is very simple. We use probabilities. Look at the past because we do believe that there is some repetition of the past, especially in the emotional cycle side. And then we believe in looking at today's evidence and then marrying that with the past and then letting that set us some game theories as to what are the most probabilistic winning directions to take in the future. Now, we're never going to be right all the time. We believe that if we can get to 70% right and 30% wrong, that's a very strong ratio. The reason we believe that we can be wrong 30% of the time because insane things happen out of nowhere that nobody could have predicted. All right. And, that's the 30% wrong. And we respect that. One of our core beliefs is keeping things very simple. All right. The world loves to confuse people. They love to throw news media out there. They love to throw jargon out there. We don't believe in that. We believe in working very hard to get the probabilities in your favor. All right. And a lot of that comes from having a concentrated portfolio. And this is research that is done. There's tons of research on this. All right. And this goes against all these companies that want to have huge portfolios. All right. But, a fewer with good companies tends to do better there. And I think Giorgio Armani says it really well here. He says, history, the past teaches us that new opportunities are born out of the deepest moments of crisis. And I mentioned yesterday at our public talk there that I actually get excited when the markets are in crisis because then it allows us to shift through what are good sound companies that have nothing to do with the crisis. But baby with the bathwater being thrown out, you get to find great opportunities that way there. A little bit about the elephant in the room. The elephant in the room has changed. It used to be tariffs. Now tariffs are not a topic because you're now seeing the positive side of tariffs come in. And that is the revenue that the government makes. So that's not the problem anymore. But there are other elephants in the room. And we've started to notice that there's a lot of global uncertainty and the fair trade is beginning to creep up again. This makes total sense, knowing that next year is a midterm election and the greater uncertainty you have in a midterm election, the greater power you can take away from the administration that's in power. So this is why you're going to see an increasing global uncertainty. So what are some of these? Right. So they're going to bring up concerns about rising inflation. All right. Now, compared to what? Compared to the 9% that you had before? No, but they'll bring it up. they'll start to talk about falling real interest rates, right? And I don't see that as a fear, but they'll bring it up. Then they'll talk about currency debasement, right? Which is, the US dollar's crashing, right? It's falling, but it's not crashing out there, right? But there's a reason for it, right? If you pay back your debt with a lower US dollar, it actually costs the country less. But most importantly, you're going to see an increase in geopolitical instability, right? And this typically happens in a lot of midterm years. So I wouldn't put it past them to say a classic example is 2022. You had that. You had Ukraine, Russia there. So midterms are rife with this. And we're just telling you, just be prepared for this. Another part of this whole change, government policy changes matters a lot to uncertainty. It doesn't matter as much to companies, but you have two types: monetary, which is the Fed, and then there's fiscal, which is basically the government. And they can change tax rules, spending, tariffs, interest rates, and money supply. This is a lot of jargon, all right? This is a lot of confusion here. But we try to take that away from it and say, no matter what, companies will adjust for it. If they tighten the money supply, companies can adjust for it. If they change things fiscally, companies can adjust for it. But our spot is to try to find opportunities within this. And there's going to be quite a few opportunities, and I'll explain them as we go forward to it. We've seen a very large increase suddenly in gold. This whole new renewed investor interest. We've got a lot of questions coming out from gold. Why not? And as you can look at it, most of this is happening basically from 2023 onwards. All right. And a lot has to do with the US dollar. But there's two main drivers to gold. Well, the one is the love trade and one is the fair trade. The love trade is marriages and things like that, buying gifts for your spouses. The fair trade is actually the bigger one. All right. And that is, what's happening in the world? How do I take away from the US dollar debasement by going to gold? But there's another side of it that isn't mentioned, and I'll bring that into it. So what you have here, if you notice the price of gold in the top chart here, these are the trends. And one sigma is basically one standard deviation away. All right. This is kind of like the simplified example of it. And you can see that the gold is now at the 5 sigma price. This hasn't happened for a long time. All right. In fact, since 1970, it's never happened. So this kind of becomes a concern because this can't sustain itself. Well, usually it can't. So a lot of people are buying now into it, understanding it, but they're not realizing how far from the norm it is. So realize this now. What's going on here? I'll explain it. So if you go back to the 1979 era, you saw another large sigma event, not 5 sigma. If you go back to 1970 here, you'll see that the gold was about 3 sigmas away, right? Not 5 sigmas. But then after that, if you notice in 1980, 81, there was a recession there that also caused this one. It dropped huge, actually. All right. So you can see that the drops can be very, very large on it. All right. So this is what happens when you go to a kind of a 5 sigma event. So even though gold's doing really good and why, the question should always be, why is it doing good? I'm going to come back to that later. Okay. As to why. But the aftermath of a large sigma event is usually not very good. I don't know when though. All right. I don't know what the trigger will be. The other thing is we're seeing a large increase in world disorder now. Maybe that's because this administration in the U.S. is pushing the buttons of others a little bit too much. But it's also about trying to create dominance and revenue in their own countries, right? So, it's the standard players. We all know that these guys have been there for years. They were there when basically Clinton was there. They were there when Bush was there. They were there when Obama was there. These characters don't change, all right? So the story stays the same, but yet each time it's like there's a new story to it. So, we'll tackle that a little bit later. What does it mean? But again, I'm going to go back to Larry Ellison, who we used last time as well. And I do believe he makes a lot of sense in certain things that he does. And his story is incredible for what he did. But we apply a lot of this to our company, this kind of a thinking and the way that you should be thinking. So if you do everything that everybody does in business, so think about investment companies, they do everything like that. We're going to be like Fidelity, we're going to be like this, we're going to be like that, right? You're going to lose. The only way to really be ahead is to be different. And that's to figure out what is your difference. Our difference is in concentration in portfolios. All right. Our difference is in communication level. Our difference is in our social meetups. All right. That's the difference. And that's what Larry did when he traded Oracle. He wanted it to be very, very different from it. And the only way to go ahead is to find errors in conventional thinking. We constantly challenge conventional thinking. All right. That means some prices drop, the stocks drop, and they say, oh, it's cheap. Well, it becomes a value trap. You can't just go by the lessons of last year or the great investors of last year. There is always a change happening, and you got to be able to change that. And he changed it as well. And innovation is a key part to it. And we look to innovation in companies and what they're doing. You got to be prepared for everybody telling you you're nuts. And we've seen that in bucket loads, right? When the markets were down in April, and we went in with strong positions, we had a lot of people telling us, you're nuts. This market is going to drop further. And yet we stayed to our conviction, and we bought some very interesting positions then. And lo and behold, a little while later, they were right. We're not going to be right all the time, though. But we do believe that when people are telling us we're nuts, that kind of gets us to thinking maybe we are doing something that's right. So take those lessons from there. Again, we're going to go through the bad news, the good news, crash recession, which is literally every time they talk about it, and the what now. We have a standard process, right? And I use this all the time. If you notice my daily notes, they're there every day, all right? And that is we put a medical look at things. This comes from my background in medicine there. All right. And when you go to your doctor, he just doesn't willy-nilly guess, oh, you're going to get a cough, or, this cough means this. They have to look for things, and they have this tablet that they go when they do their checkups. It's blood pressure, it's EKGs, it's EEGs. Well, we don't do that in the world of finance. We like listening to what the media says, or, this thing. So we have these indicators there, fear and greed, railway tracks, which is trends, basically. We look at sentiment trends, and then we look at speculation, what's happening in the speculation world, and ultimately volatility. All right. And that's how we check this patient. This patient is the markets currently on it. So we have something that we use in our fair greed. This is all publicly available. There's no, it's free. But we have this indicator that tells us to be either excited or not excited. So when you're in neutral, that's actually a good spot to be. But as you go into greed, the world goes into greed, and extreme greed. That's the worst spot. That's when we become cautionary. But as the world gets into extreme fear, we become more excited to it. So we do a lot of buys at extreme fear and a lot of sells or a reduction in risk at extreme greed. So if you go back to April the 8th, and I keep on bringing this up, that time you had extreme fear at 4. And we were very aggressive then this year because of that. All right. But a lot of companies weren't. They were too busy listening to, oh, this is going to be terrible. Liberation Day. Trump's going to do all these tariffs. It's not going to help the markets. The world's in trouble, right? All this stuff that was going on there. And yet, if you look at today, September 25th, it's at neutral. This is straight in the middle. All right. The 50 to 51 is straight in the middle. It's not fear. It's not greed. It's basically what I'd like to call Goldilocks. And as I showed you in the previous shot, this is a good environment. You're not ready for a crash. You're not ready for anything. You can have just drops, the things like that, but nothing really meaningful. All right. So this patient is actually in a really good state. And I don't care about the valuations of the markets, because I'm going to explain why that doesn't matter, because, you got to look at the revenue that's being generated for that. So if we look at our trend lines, in April the 8th, you saw it drop down, and you saw it drop down very sharply. And so people were panicking. This is well below normal. We didn't know where it's going to end. But then since then, now you had a large recovery. And if you look at it, each time in that recovery, you had drops. Right. And each time in those drops, the media came in and, other investment managers came in and said, oh, this is going to be trouble. This is going to be trouble. And if you notice, those drops have lessened and lessened, but the media news hasn't decreased. Each drop is considered this. So a 2% drop is considered the same as a 10% drop, according to media commentary there. So you start to see this, and you'll see this again and again. But actually what's happening is you're working up. And since basically July, you've been in this world of new all-time highs. And yet each time it drops, there's a fear being built into it. Now, fear is our greatest friend, not our greatest enemy. All right. And that's what we want to position is. So you're going to hear a lot of news and noise about it. But just remember, we're at this period where there are all-time highs. And just because you have an all-time high doesn't mean it's going to go lower. So we've seen this now, right? If you look at the monthly now, you see rallies to the high and all this stuff going on. That's fine. All right. We saw the big drop there in September. So September is a weird month in that it's the last one at the third quarter. So you get third quarter. And what happens is if you have a nice little recovery, usually towards the end of the month, there's a little bit of a portfolio shifting going on in institutions and fund companies. So what happens is they have losers throughout the year. You've only got 3 months left to recover because you want to show a great year-end number. So if a investment company is not producing results, all right, what they will do is at the end of this quarter, they'll try to say, okay, sell these losers to buy the ones that were winning. And, hopefully create a more positive result as it goes forward. Okay. And this is what causes the September shakeout. Remember, this October, the second week of October was earnings startup. All right. So earnings season start the second week of October. So there's this little bit of space where you can jiggle things around. And so this is what typically creates the end of September or the end of the third quarter volatility. And we haven't seen it this year up until this point. But you will start to see slow amounts. It may not be as dramatic as the past ones. Right? And this September is very strong because, you've had a lot of great earnings come out in this last earnings season. So this is why this September is stronger. But that doesn't mean that you're not going to see a lot of wiggling going on around. And they'll take any single piece of news and just hype it up. So, PCE or inflation is always usually around an inflation news. All right. It's either inflation or it's around about some kind of a geopolitical event because they can't hit earnings because earnings are very strong. So it's usually those two news scenarios, which actually have nothing to do really with the earnings of a company. They want to distract you from what's coming after October, the second week of October, which is again earnings. So they have this little time period between the last week of September to the second week of October where they can really get you excited or depressed. All right. And this is what they try to do. This because they're doing their portfolio rebalancing. So if you look as of September 22nd, you had 15 trading days or plus 3.61%. Or, September. This is the greatest September since 2013. And you can have September's positive, right? Here's all the month to dates on that. And we'll go a little bit deeper into that. Now, when you have a good September, all right, what typically happens after that? So 82% of the time, the return for the rest of the year, October, November, December, is plus 5.3. Now, that's 82%. It's not 100% of the time. But that's a high percentage positive. That's not to say that you're not going to have a negative month. I'll bring that up later. But we're still in a strong market. The reason is because earnings are still very strong and interest rates are being brought downwards. Okay. So if you look at the markets now, there's something called the golden Fibonacci. All right. This is a technical term. Fibonacci numbers are a natural number. It's actually what's called the nature's number. So when you look at plants, you look at flowers, they all grow in the way of a Fibonacci number. And it's a great piece of reading about how the world gravitates towards Fibonacci. Right. Okay. And so this number is telling you here that at a certain level, all right, you're going to hit this. This is a kind of a resistance number called the golden Fibonacci. Now, it's not resistance as in going down. It's actually a shift number, which means that if you have a breakthrough, it accelerates after that. Or if you have a piece of bad news, it can accelerate downwards, right, to the previous all-time high. So you're going to hit that at some point because that's the natural gravitation. Let's call it nature's forces. But then at that time, there's a pause and it's trying to assess, where do I go from here? And, it's either an acceleration or a deceleration. So we don't know that until it hits it. But it's 694. So in the S&P 500, we're at 660, something like that. So 600, another 300 points. That's the natural Fibonacci. It's not perfect, but it's a little bit more than the average. All right. It's actually a lot more than the average, but it's worth paying attention to. Also, I pay a lot of attention to breadth. Breadth is very simply the number of companies going up versus the number of companies going down. It doesn't tell you how much percentages or anything. It's just like looking at a class of students and saying, 60%, 60 students, or let's say a class of 30 students, and you're saying 20 of those students have grades above average and 10 of them have grades below. That's a class that's actually pretty good. Or you can say 20 students are below average. That's a class that's not good. So you get a sense of where the market is. And if you look at it, this is as of today, risk always shows itself through breadth first. And I've highlighted it here. So we had a drop in April, but that drop in April didn't really start. It started showing up back in February when you started to see breadth drop, and then breadth dropped very, very fast. Remember, the drop was April the 8th, but this breadth signaled it a month before. Okay. And if you see a dramatic drop like this, a drop, pause, drop, that means that breadth is really telling you something. All right. And then you saw this breadth improve, and it improved well. That was the huge recovery, but it happened before the markets recovered. And now you saw the same. So right now, breadth is telling you that we're in for a pause. Now, this has to go kind of below where the previous low was over here. It has to go significantly below it. All right. That's when you tell the truth. So if you look at the one here, you saw breadth drop significantly below the previous one. Then it becomes concerning. So again, breadth is giving us a warning here. All right. Even though it's giving us warning, we can feel comfortable that the breadth is still strong because you see earnings growth, and the earnings growth has now shifted from the Mag 7, right? The consensus growth is still high, Mag 7. But when you look at the other 493, you see the growth go even higher. So earnings growth is going higher. So this tells us that actually breadth is going to improve. The others are catching up to the 7, as in earnings growth. This is a very, very healthy sign. This is telling you that the patient is recovering in all areas here. Okay. So put calls is about speculation. And in put calls, you basically see speculation on the put side, which means a lot of people are protecting themselves from a loss and they buy insurance. And the market usually goes the other way because, they don't win out. You buy an insurance and another happens, that goes to the end. Whereas on the other side, when you get a lot of calls, that becomes very cautionary. You start to think about, should I be reducing my risk? So where are we now? We had too much fear on April the 8th, and the call ratio was almost at 1. And this told us that this very rarely goes higher than 1. But when it does, it's a buy point because it doesn't stay there very long. So there was the trigger as to why we should have invested. Now, though, the put call ratio is very low, 0.6. So this is telling us that even though we believe that there's going to be recovery, it's going to be very, very choppy, and that maybe we should be very cautionary in it, right? Hold a little bit of cash in it. So this is the volatility. Now, the VIX side of it, right? So that was put call ratios, right? So the VIX side of it is basically, if this is real money, by the way, is people put real money down companies to reduce the volatility of what's ahead by 3 months. So we saw on April the 8th there, you saw it go up to 50. That became an extremely good point for us. Anything above basically 30 is dead. And so our rule in investing to look at it is when it goes above the median line to be a little bit concerned, but when it breaks below the median line to be very excited. So where do we sit now? Well, we've kind of been below this moving average line. All right. And we're kind of like in this line with it right now. So it's kind of telling us there's a complacency in the market and it'll either go up or it'll go down. We don't know. Right. So VIX is not being a problem right now. It's almost waiting for some kind of a news to scare it into something, and something will happen. However, there is a secret that we use, like I explained to you, to doing VIX, right? Whenever you get spikes of VIX above 30, it becomes a buy point in the markets. Buy point, like you're still going to get higher there, but it becomes a buy point in the markets. So we're not there. You're at very low VIX, so it's not a screaming buy. But again, this shows you fear is your greatest friend on top of it. Also, I've explained that there is a line to the bottom of the market, and it's been there since basically 2008, and that is called the 200-week simple moving average. 200 weeks is basically 5 years. All right. So if you look at this 200-week moving average, every time it's kind of hit that or a little bit gone below it, it's been a screaming buy. We're not close to that. But I'd like to highlight it in that in the back of your thinking, this is what happens on this one. This changed since basically 2008 because the functions of the market changed since 2008. It's actually become stronger because of the more ETF players that are out there now. I've always believed in this, and I've said it at literally every talk. All right, investing is the battle between fear of the future and faith in the future. The media role is to talk about fear of the future. Our role is to have faith in the future because we've survived so many scares that the media has put in front of us. All right, and this is what I want to keep on harping on there. We've seen a large increase that's been happening in the top 10 stocks. Again, it goes to our philosophy of concentration. But Mag 7 is now roughly 35% of the market. It's a new high in concentration level. This doesn't mean that the market's going to crash. It just means that these companies have a greatest slice of revenue. And that makes sense because you take a company like Google, it's not one company, it's like 7 or 8 different companies. So each company on its own would have been a separate company, but because they're combined, they get a bigger revenue slice. Nvidia isn't just a chip company. It's a chip company that's involved in many different industries. So you get the revenues from all of those industries. Microsoft, right? And like literally the whole world uses Microsoft. Or Facebook, right? So there's a justification as to why it's taking such a concentration level, because those companies have higher earnings and they have a higher cash level. So it's nothing to be afraid of here. Now, T10 versus T2.0. This is very, very interesting because we have an interesting president, and that's putting it kind of mildly. He's driven by ego. And this ego is, his primary measurement is the stock market. So if you look at the green line, that was T1.0, which was his first term. By the way, from the beginning of the term to the end of the term, his total return on the stock market was roughly around about 68%. So he wants to beat that. In fact, he has such an ego, right? And that can be an advantage to us because we know what he wants to do is that he wants to not only beat 68%, but he wants to beat all the other previous presidents' returns. So this is why he's put such a focus on the Fed, on tariffs and everything. And everything is about bringing revenue back into the U.S. and that revenue then going to companies. And you saw it when he said, we're going to take a stake in Intel. And now you've seen it just yesterday. They said they're going to take a stake in lithium. So, you got Intel, which is chips, and then you got lithium, which is electrical vehicles. And this is the first time the U.S. government is really taking a step and taking a stake in companies that are going to be meaningful. So you're going to see a big change because of this person's ego. We don't care about his ego. We care about what does it mean for us. And that's why we're kind of driving towards it. And we think it's a very positive outlook. Again, as you can see, Trump 2.2 is going to have, it's not going to have it without warps. right? Because as you can see, in a midterm year, and their midterm year was 2018, in Trump 1.0, we're going to have a midterm year next year. And like I've told you, there's going to be, the bad guys are out there. And the bad guys want to cause stability, and they want to tie his hands so that tariffs and things like that can't be done. And the best way to do that is make him lose seats in the midterm. So you can expect a lot of outside activity to try to disrupt the U.S. And this midterm becomes very, very contentious, right? The media is going to go crazy. Well, we should expect that because there's going to be a help to us in there. If you look at the history, though, of large drops, you'll see something very, very strange. They all happen in the first half of the year, first quarter or first half. So if you look at 2022, the last midterm of Trump 1.0, you notice that the drop was in the whole first half. And it actually started on January the 4th. And it was started by China deciding to dump U.S. T-bills. Remember, that's also the start of the increase of gold. All right. So what China did on January the 4th was dump a lot of U.S. treasuries on the market. When you drop U.S. treasuries on the market, that drops the price and yield goes higher. Yield goes higher. That meant interest rates go higher. Interest rates go higher, and that caused kind of like the inflation rate. And then you had this 9% inflation number come up. So it started in the first half. So we would not be shocked. We can't predict it. We wouldn't be shocked if you see a lot of instability in the first half of, next year, 2026. It will be quite normal. Okay. And let's take a look at why it would be normal, because we haven't had a 5% drop in the markets for a long time. All right. Remember in 2018, the last midterm, we had a 10% drop and we had a 19% drop. Okay. That was the midterm. Well, then in COVID, which was an election year, you had a 33% drop. And then in the next midterm, you had a 25% drop. Okay, this year was that's why we weren't concerned. This is not a midterm year, so an 18 didn't matter. But we haven't had a 5% drop. So we should be looking to say this time, not to be scared, but figure out how the advantages. A rule that we have, though, if you look at history and research, is that whenever the market drops, all right, like a 20% drop. Well, let's take a look at probability of loss time these happens. When that happens, usually a few months later, let's say 2 years later, all right, the markets are up and they're up roughly about 32% from that point. And so how do you protect yourselves in this one? We don't know how far it's going to drop or anything. Like 20 can turn to 30. So this is where understanding options matters. So you start to buy little stakes into long calls. That means that you're okay with the loss, but if it goes upside, then you've actually booked a larger profit. So utilizing long calls on a dropping market, I mean, you take the risk of you lose your premium because it drops. But if you stretch it out over 2 years or 1 year straight into a leap, then most likely you're going to win. You can sell it anytime between it. So this is how you manage losses, all right, and how you take advantage of them. We always remind you of bad news because the world isn't full of good news. So what is the bad news that we're hearing right now? And this is kind of concerning to us, is that job growth, right? Job growth is hurting. And there's many reasons for it. Okay, you can call it AI. But the other part that everybody's forgetting is the demographics of the countries are changing. You got more seniors and they retire. And those jobs, once they're gone, aren't replaced with other people. They're replaced with, some cheaper people there, right? And if you look at unemployment across the world, it's kind of interesting to see where it's happening. It's primarily, look at Canada, 6.6% versus the US. Now, this makes sense. So if you have a country with higher unemployment, even China's at 5.1%, which I don't believe this number at all. All right, I think that's a cooked number, but I'll let them decide on that. All right, but if you see it, these are the countries that are in higher problems. All right, that means that when you're unemployed, you're not a producing entity, you're a cost person. So think of if you have a company and people are not working there, they're lazing around, they're taking their smoke breaks, they're not doing anything. All right, well, that's a cost to the company with no revenue generation. When you're employed, you're actually generating revenue for the company and for the country, because the country gets to tax you and the company gets to make profit off you. But if you're unemployed, you're not really paying that much taxes and you're not generating any revenue. So the higher the unemployment rate goes, the worse it gets. And Canada is in particular trouble. I'm sorry, but we need to do some changes. In fact, if you look across Canada, Ontario is 7.7%. That's higher than the average. All right. And if you look at the east side, look at PEI at 8.1%. All right. Now, where is it low? Like, look at Northwest Ontario. Okay. So there's not a lot there. So I can agree on that one. Okay. But look at Alberta. Alberta is 8.4%. Okay. Even Quebec's at 6%. This is very large, by the way. All right. So realize that unemployment is going to impact Canada, and it causes regulatory changes, because if people aren't working, the governments have to provide for them, and they can only provide by, so they create more programs like carbon tax and all this other nonsense so that they can grab the money to pay for the unemployed. You want more people working, so they put into the government coffers and not take out of the government coffers. Right? And that more people can only work if business is growing and it's conducive to business here. So you're seeing this big difference in ages across it. And if you look at the biggest people that are hurting right now are those, if you look at the one on the left-hand side, employment is really negative in July 25 for those people that are 25 to 54. That's most of you. All right. You're not getting jobs. So you're being laid off, and it's not easy to get it. Unemployment by age, 15 to 24 years old, coming out of universities at 15%, just below 15%. This is very scary. All right. This is much more. Youth unemployment in Canada is at a severe level. Okay, so if you look at it here, you can see this is the unemployment amount. All right. Youth unemployment, it's at about 14.7. This is the worst since 2010. All right. And it's now into a crisis. All right. Students are not getting, going into unemployment after graduating from their degree. So the best thing a company could do is get support from the government to take on people and teach them a trade or teach them about the investment. So if like there's companies out there, you get the government help to try to get somebody young in, that actually supports the whole thing, because your cost is low because the government's giving you help on this, but also that youth is getting training and hopefully they're looking after themselves. This will impact future generations, this level of unemployment. Job searches are getting more difficult. 27 weeks or more of unemployment, there's more of them now. Okay, so people are getting tired of even searching for jobs. The amount of permanent layoffs has increased, right? It's a concern there. Right? And when you get this higher level of unemployment, then you start to get a higher debt load in the house, because they need to get revenue and they can't get it from work, so they go out and borrow. So, congratulations, debt load is increasing, and people start taking gambling more, right? So you've seen a big amount of speculation happening in the markets there. And you see that in what's called zero date to expiry options. 80%. Yeah, I can't make this up. This is crazy. This is from Bank of America. 80% of NASDAQ options volume is 0 days to expiry. So they're literally betting on what happens the next day. And it's huge. And this has led to a large increase in margins, and that becomes a concern on it. If you look at the large increases of margins are now up 139 billion. I'm not trying to predict a crash. I'm just telling you that this point of volatility that leads to the midterm is building up. Right? It's like you see somebody that's doing all the wrong things for their bodies, and yet they want to be fit, but they can't be fit because they're not exercising, they're not eating right, they're taking the wrong things, they're abusing themselves. This is kind of what's going on right now. And if you look at the inflation adjusted one, you can see literally each time. All right. And what I'm showing you here is election years and midterm years. Election years and midterm years is when they increase the most and bring it down. So next year is a midterm year, and margin debt is high. So I'm trying to give you a lot of reasons why you need to be a little bit cautionary in your thinking, right? We're also seeing it in building permits, because if you've got a high unemployment rate, you're not going to be able to buy a house or anything as much, right? So if you look over here, you can start to see building permits have now declined for 5 months, right? This is in the US that they're showing this, but Canada is no better there. And you can see office delinquency rate. So RTO, return to office, is something that everybody's company is pushing now. So you can see it in the subway traffic. I went just to see for an example, and I was surprised how packed it was. But I didn't see any happy faces. Think of all the people that are returning to work, but they're not happy about it. Okay, so what will happen is inefficiency increases for people working at the office, from home to the office. They're not really happy as much, so they will actually work less, more breaks, more lunch breaks, leave early. Okay, so it's not really good. And you're seeing the effect happen in commercial real estate. Delinquency rates are high. So they're trying to give you a smoke and mirror and say, oh, because of return to work, commercial real estate's going to do well. All right. And well, not really, because these are long-term leases. They're not exactly hiring anything new. So newer companies that are kind of saying, we'll work with a smaller workspace. All right. Desk sharing and all that stuff happens. And you can start to see it in the US in new home prices. Okay, so again, if you look at it here, you can see that the peak was 2023. And you can see this is Lennar, a home builder. And it's saying that our prices have dropped from 491 to 383. This is not a good sign. I mean, dropping interest rates doesn't even push up the house price. It's actually that you need a lot of buyers coming in. All right, to justify the supply. So you can say, oh, there's not enough supply. There's not enough supply because nobody wants to sell at these prices. So you can't increase supply just because the prices are lower or the interest rates are lower. You have to have a catalyst to move it. So unfortunately, this is going to make the real estate market very, very challenging. All right. And now what you're seeing in Canada is, and this is just from this week, the condo crash, CBC News. It's a great video, by the way. If you go on YouTube, search for Canada's condo crash in the current, they did a fantastic analysis of it. There is way too much condo inventory out there that was built in the peaks that is coming due now. And some of them aren't even being completed. So you get some residency and some not. But where does this all lead us? So if you look at, you're having a rise in the Chinese stock market, which again, I think is a lot of cooked up stuff. But you're actually seeing a slowdown happening in China. All right. And this is the real kind of numbers there. So industrial output has slipped 5.2%. Okay. So industrial output, why? Because of tariffs. All right. And China's got, I'm going to show you something that's going to be crazy later on. Okay. But China's got a large problem coming up, but they're trying to hide it from everybody because, they're China, right? And remember, you don't get the same reporting. So the fixed output, there's been a slowdown in expansions, right, since January to July period. And urban unemployment is at 5.3%. So this is going to just keep on increasing there. Why? This is incredible. This is the UN World Population. Okay, and this is kind of very, very interesting. And you can see the blue line here is China, and this is the US. You can see the demographics of the US actually increasing, which gives you a sustainability to the US. But what's concerning is this blue sharp line going down. So China's demographics is going to work against them, because now what's going to happen is you're going to start to see a decline in the population, but the older people, because older people are dying and everything. So people die. So you don't have enough support in the manufacturing and the production to keep on producing things. There's not enough people doing Google searches or things like that in China. So if you look at the growth of an economy, it's actually based on the demographics. So China's been doing well because it had a large demographic growth. I actually don't believe their numbers. I don't believe that they have $1.4 billion. I really can't trust any Chinese numbers, right? But I'll take the numbers that they're saying. But this decrease is going to take China back to what what the UN is saying to 1950. All right. So you've got this big shift. India's in the same problem, but very slow. They'll still have a very good economy based on that. And that's why India becomes exciting. All right. And the Europe is in a similar problem, but slower. So the big danger is China. So think of what we're saying, slowing economy, unemployment rising. You have this demographic. So what does China do? They know they're having a problem, but they can't put their assets at risk. So what they did is they bought a lot of gold, and that's to try to protect their treasury there. So they've created something, the Shanghai Gold Exchange, right? It's big vaults, and there's a big vault in Saudi Arabia, and then there's a Shanghai Gold Exchange, and they keep on buying into gold, and this is what causes golding, and that's the idea is to protect the currency, renminbi, right? Because they know China's going into trouble, all right? So this is a big kind of protection thing. They don't have the cash because remember, they're not doing trade anymore as much. This is operational. They're working on this. This is real, but here's the thing about it. They don't hold the most gold, right? So the most gold is held in China, in the U.S., what they call Fort Knox there. Whether it's real or not, it's still in the U.S. So somewhere in the midterm, later in the midterm, Trump can very easily, if it's not going his way with the trade deals, decide to dump gold on the market. I'm not saying he's going to do it, but this is game theory. If he decided to dump gold on the markets, let's say it's trading at 3,700 or 4,000, and he said, I'll sell it at 3,700, you'll see a drop. Then it drops down, he said, I'll sell it at 3,000, sees a large drop. But what happens, it actually hurts Saudi Arabia and China's gold exchange. And this is how you force those people that are against you to actually work with you, because this will be crushing. Not only do you have trade problems, but now you've taken the basis of your currency protection and destroyed it. And this is what's kind of like game theory working out there, right? I don't know if it's going to happen, but if I was Trump, I would definitely start thinking about this. Good news. The good news is that there is strong earnings growth. All right. And you can see it. There's no slowdown. If you look at the right side, there's no slowdown in relative earnings trend. All right. And there's a reason for it. But Europe is stagnant in earnings growth. So even though you see the European market going up this year, that's a lot of speculation based off Liberation Day, tariffs and things like that. There's actually no real major economy in the US that people really want to go towards. Okay. So when you look at where are the earnings coming from, they're mostly coming from the large cap. Although mid caps and small caps have recently started to improve right here at the back there since May 2025. Okay. But if you look at the longer trend, which we looked at it, the forward earnings expectations is what drives the stock market. The blue line is the forward expectations. And if you notice, they kind of lead it, not behind it. They kind of tell you before something's going to happen, it's going to be there, right? So that's there. And even if you go all the way back to 1935, you can see the most important driver of the market is earnings. So the fact that the U.S. has a strong earnings potential, all right, with new industry and everything, makes a big difference. And you can see why the markets have gone up. And that's basically been in a big trend line. And most of the earnings that are coming up are from the Magnificent Sevens. Right? So think about it. In the last 7 years, 730% of growth has come from earnings of the Magnificent Seven, compared to 63% of the equal weighted index. So there's a reason for this drive. And the other reason is buybacks are happening. Buybacks are very, very large. We've told you that's a key part. And if you look, last time I explained this as well, if you look at the history of companies, those companies that do more buybacks tend to, over the long time, have the greatest returns. So buybacks becomes a big reason to look at certain companies. And so what has this led to? This has led to a large kind of increase, a breakout that's been happening in the markets there. All right. So this is why we're seeing these all-time highs. And hedge funds have now caught on to this. I'm not a huge fan of the hedge fund, how they speculate, but just seeing them. And so in the last little while, right, actually last 2 months, they've been buying technology like a large amount. It's the third fastest pace in 5 years, all right, of doing that side of it. So what do we need to consider? All right. That was the good news. So the first thing is, look at the amount of pessimism that's gone out there. This is September 14th, and look at what the media is saying. Fund managers haven't been this pessimistic on the economy since the early days of the pandemic. So think about 2020, when you had this pandemic, and how the fund managers would tell, oh, this is terrible. We don't know what's going to happen. The world is locked, closed. We're never going to go back to work and all this stuff. But now let's take a look at their pessimism. All right. Now, I believe in proofs. Actually, what happened? Well, here's the proof. This is when they were panicking. High pessimism right there. But look what happened afterwards. Okay. So their pessimism is our advantage. What matters in the long term? The growth of revenue, growth of sales in the long term, over 10 years, is the greatest driver of return. Not in the short term. In the short term, it's PE multiples and PE growth, 46% of the time. But as you get out to 10 years, it's those companies that are selling more products. Very, very simple. You sell more products, you make more revenues. An investment company that is not selling products is not making as much money. So the whole idea is, how do you sell more products? How do you sell more cars? So when you look at Tesla as an example of a car company, if it's selling more cars, it's got a growth, then it's doing well. If it isn't, then it's not doing well. It really comes down to that. The Starbucks is selling more coffees, it's doing well. If it isn't, it's not doing well. Whatever company you want to say. So look at the sales growth. All right. And you can see that this market is supported by higher earnings. And so this earnings seasons matter. Next one's going to matter so much. So are we in a bubble? Here's what a bubble is. When you have low earnings growth, all right, but high price. What we have now is we have actually got earnings growth increasing with price growth. We're not in a bubble. I'm using NVIDIA versus Cisco here. Right? Cisco had a great increase in price, but their earnings didn't increase as much as the price increased. Here we have price increase, but earnings increase as well. So NVIDIA, we're not in a bubble state. There's no real major overvaluation. There's an overvaluation in general industries, and that's because you've got a few companies leading it, and the other ones haven't caught up. I just told you that they're trying to catch up. Probably the most important lesson you're going to get from today's webinar is going to be something simple that they think that people think that they know, and it's called the rule of 72. Now, everybody thinks that they got it, but I'm going to tell you, you haven't really got it. Okay, so let me tell you why rules and why returns matter. Okay, so this is very, very important. It's probably the most important lesson you're going to get for a long time, especially in your own lives there. So let's take a look at the rule of 72. It's very simple. You take the rule of 72 divided by a return, and that tells you how long your money is going to double. And doubling is an important formula, right? Because you want your $1,000 to go to 2,000 or 100,000 or 1 million to go to 2 million. You divide it by the return you're getting. And over that span of time, if that's the average, then you're going to double your money. It's played out through history 1,000 times. Okay. But let's take a look at it at another way. Because when you do this 72 divided by interest rate, it tells you the years to double. But I'm not really concerned about that. I want to know what interest rate do I need to double my money. So you take 72 divided by the number of years, and that tells you the interest rate. And that's what drives things. Interest rates, the interest rate that you're returning matters the most, because that's what identifies your growth or your financial plan. And you know, with higher rates of interest, you're going to have higher volatility. I've just explained to you why volatility and fear is going to be your friend. So my whole role that I've lived with, the whole thing I've lived in is never be fearful. All right. If you have a drop in the markets, understand that and be brave about it. So if you take a look at this rule of 72, you realize that at 2%, it takes 36 years to double. But if I can get a 15%, it's 5 years to double. If I can get a 20%, it gets to 4 years to double. Now, these are not easy numbers. All right. But if you want to double your money in basically 2 years, you need a 50% rate of return. So now you change the argument from years to what return do I need? And honestly, it's going to come with volatility in it. So what about the triple your money? And that's the rule of 115. So if it takes 3, if you take to double your money, let's take the 10-year number, 7.2 years to double your money at 10% return, to triple it divided by 115 takes 11 years. So, you can start to work the maths on this one, right? So again, this is why having a return focus and understanding volatility matters. So this is comparison, and there's a lot of people that say, oh, we need balanced funds, we need this, and that's fine if that's what your risk. I'm not discounting them at all, but take a look at history. If I had a equity portfolio only versus an equity portfolio that is 60% bonds, the blue one, versus equities, 60% equities, 40% bonds, what they call a balanced portfolio, you can see, of course, I'm going to have higher volatility. And sometimes it can last quite a while. But over time, the return of the straight equity was, let's say, $33,000 for, $1 kind of invested, all right, versus $1,000 kind of invested versus $4,203 on the balanced one. Bonds just can't generate the growth of an equity. They can try to reduce the volatility, which, by the way, they haven't done. So there's this whole misunderstanding about why do I have bonds in my portfolio? And so people get excited about bonds because, oh, you know what? I get a guaranteed return. You don't get a guaranteed return. You get a guaranteed return with a fixed bond, with a CD or a GIC or a term deposit, but bonds fluctuate as well. All right. And you can see that by some of the negatives that they have. But the key thing is, if you can understand volatility, then you can try to take advantage of it. So now where are we? We've had over 5 months of a 30% gain in the market. Let's put our game theory hat on. Remember, like I try to go to the past, and you'll notice something interesting. 3 months later, this is from September the 9th. If you look at history from 1957, 3 months has been 100% positive. 6 months has been 9 months has been, 1 year has been. So it's high probably, not guaranteed. Like I said, 30% of the time I'm going to be wrong, that we'll probably have a very good period out here, right? And the average gain is around 18% a year later. So, from here to next year, something around 18 is what they say. Now, we've also, NASDAQ has had 6 months of green. All right. So that's the key thing that happens there. Which companies are leading this? Don't know which industries. Forget about the companies. Let's look at the industries that are leading it. Well, take a look at the blue. It's technology. Now take a look at the green. It's communication services. Now let's take a look at the pink. It's financial services. So, who isn't there a lot? Healthcare. Healthcare is only one company. That's J&J. All right. So reality is technology, communication services, and communication services primarily technology, because it's Google and Meta, Facebook there. So that's it. But other than that, so technology and banking, financial services, right, has happened there. Right. So these are the drivers of the economy. They don't really change as much. I want to go through a midterm, but I want to explain the Trump midterm. So this is the midterm for 2018, not 2022. I'll bring that up later. 2000. So this is what happened with at the beginning of the year. It went nowhere. The first quarter, not a lot. You had a little bit of a drop. And then in the second quarter, you had this increase. But most of it happened in the fourth quarter. But why? Because Powell decided over here to increase rates. Okay, so the same thing you see, S&P takes the biggest loss in 5 years at the beginning, worry about inflation. Right? I told you the two things that are going to scare the markets are going to be inflation talk or war talk or global thing. So you hear that. And then right here, September, strong economic growth, right? 10%. Then you had this consumer focus, Amazon later. But then again, you had again a roundabout inflation concern there and what was going to happen to growth there. So that's right. So it was basically first quarter and the last quarter there, right? Now, if you take a look at what happened with technology stocks, though, right, you will see that second quarter, this is 2008 in midterm, and then it dropped. But look what happened in first quarter the year after. So this is after a midterm. And you can see it recovered very, very fast. Basically, you took all the negatives of the last year and you built it back up in the following year. Why is it different slightly this year? Because money market is at a record, $7.7 trillion. It's doubled over the last 5 years. There is a lot of cash in it, in the system. That's mostly in money market funds that are generating 4.1%. When that interest rates go lower, money market interest rates go lower. So every quarter point drop means another quarter in the interest rates. So as the market comes up and money markets is going lower, people will shift out of the money markets into other vehicles. And that kind of helps the equity markets there. And why I'm not as concerned about this margin debt, because even though you have high margin debt, you also have high cash on the side to protect you from the margin debt there. All right. And if you look at the debt as a percentage of the S&P 500 market, you will see that when debt as a percentage of market cap goes up to 3.3 just before the 2008 stock market crash. That's when it's gone too far. We're at a very low debt to S&P market cap. And this is what Buffett in his GDP calculation forgets about it. Right? You know, is that GDP, the growth of the stock market compared to GDP? Well, you're forgetting this part of it, the debt part of it, right? So this is the part that matters. You've had a lot of all-time highs, way more than 20 right now. And what's had the most all-time highs recently is actually gold, followed by country weight, followed by EFI, followed by the US, right? 28 increase in. What has not had a lot of all-time highs is small caps. All right. So when you have an all-time high, is it a good period to invest? Actually, history shows you yes. New all-time highs leads to more all-time highs. 1 year later, it's up about 13. But look at 5 years later, 82%, all right, of them are higher. Bull markets last longer than you think. All right. So roughly it's about 5 years. So our one started in October 2022, 2023, 2024, 2025. This is the third year. Typically it's about 5 years. So again, this goes to that whole thing anywhere between the fourth and fifth year. So, I told you midterm next year, but after that 5 years. So that's how long something lasts. And remember that 200-week moving average that I told you? Now I'm going to shift to the 200-day moving average. This is no way am I enforcing technical analysis. I'm just showing you what history has shown. If you look at the greens, the green and the reds are the most, forget about the chart. Look at the stripes. So when it's green, it means it's above the 200-day moving average. When it's red, it means it's below the 200-day moving average. And so forget about the chart. Just look at the colors. And you can see here that more often than not, you have more green that is above the 200-day moving average than you have red. So what this tells you is that whenever it starts to go below the 200-day moving average, you should put your cautionary hat on. All right, the construction man's hat on. But that makes more sense. And then when it shifts back to above the 200-day moving average, now you've got an opportunity set built in there. All right. And here's what Powell has said in the past. He said, right now, what he's saying is literally 2 days ago is stocks are highly priced. Now, remember, this is the same guy that in 2021 said that inflation was transitory before it went up to 9%. So we don't have a lot of faith in what Powell says. Powell's not an economist. Powell didn't go to school for economy. He went to school for law. This is a lawyer trying to be an economist. And I know he has great economists on his team, but unfortunately, they're not as great as they make it out to be. All right. The Fed's budget for research is something around about $4 to $7 billion a year. And yet they've never really predicted anything here. So let's take a look at the crash. Well, it's highly, according to the Atlanta Fed, it's difficult for you to have a recession when GDP is improving. Remember, the GDP is improving because more people are buying out the U.S. goods. And the reason the GDP is improving because the U.S. dollar has fallen. The more the U.S. dollar falls, the more other countries can buy the goods of it, even including tariffs. So let's say another country says, I'm going to put 100% tariff on U.S. goods. But because the currency has dropped, even the 100% tariff doesn't feel like 100% tariff. All right. Whereas the other countries' currencies have gone up against the U.S. So even if you put a 20% tariff, it feels like a 40% tariff. So this is very, very smart thinking. This is why the U.S. dollar going down is kind of good. Interest rates, right? We just had a cut, but take a look at things. Look at the price of timber. All right. Take a look at the price of diamonds. People getting married and things like that. Well, diamond prices are lowest level in a century. Okay. And you had this interest rate. And what they've said, remember, I do not trust the Fed. I don't know. They've just proven very trusty right there. And we're saying it out publicly. So they said 2 more cuts coming. You have a lot more to go before you get to the norm. So the norm is somewhere around 2%. You have way more cuts to go there before you get there. So what did Powell say? That tariffs will only cause one-time price increases over several quarters. This is a way of telling you that tariffs aren't going to matter because it's going to have a one-time and then it's going to last several quarters. And then what he forgot to tell you is then it begins to become normal and drops. The other thing he's saying, Fed will make sure that tariffs don't drive ongoing inflation. So he's not going to let the tariffs impact his inflation point and what it means to interest rate. He's telling you he's going to drop interest rates. Downside risk to employment have risen. He's telling you that we're more concerned about unemployment happening, which is real. I've proven that to you. Long-time expectations, it's about 2% target. I have no faith in this guy at all. Consumer spending has slowed down. Again, no faith in him at all. Overall, they're expecting more cuts. And I don't know if it's going to happen or not. I can't predict these guys. But here's what the market is saying. The market is saying there's an 83% chance of the Fed's cutting in October. So you just had a cut, and then they're saying there's another cut coming. This is 83%. It's not perfect. All right. So what is the market expecting? This is kind of like just guessing kind of thing. But 30% of people think it's going to be 4 cuts in the next 12 months. Right. 5 cuts, 10%. And somebody's saying, 7%. So there's a lot more cuts. 4 cuts means roughly about a percentage drop. All right. But what is the Fed saying? They're saying 2 cuts. Right. 4.25 to 4 to 3.75 is where they're going for. And this is what the futures are saying as well. All right. Futures coverage. So there's an agreement that interest rates are going lower. Interest rates go lower. Remember what it does to money market funds? It drops them lower. So you had 4.1, let's call it 4%. Now it's 3.5%. All right. And then it'll go to 3%. At some point, people are going to say money markets aren't making any money. So the markets are betting that they will drop to 3% by the middle of next year. All right. So this is kind of interesting because most of that increase that they're assuming is going to be in June 2026. Remember, Powell comes up for nomination for chair. I don't think he will get it. But after that, you'll start to see more rapid decreases. So what does this mean to our future thinking on interest rates? Right? And this is very interesting because when you look at the current thinking on it, is that it's going to drop in 2026. And then in 2027, it starts to rise. And it rises to the level that roughly by the year 2030, interest rates are where they are now. And then it increases. So remember what that means. That means a slowdown. Remember, many times I told you the most risky years are going to be 2030, 31, or 32. And so this just, and what's the reason for it? Higher interest rates, right? So the markets are way more dovish than the Feds. So I think the markets are kind of missing the whole gap. The Feds are actually, like here, they're actually telling you that it's going to be going higher, right? And the market's assuming that it's going to stay lower. We'll see at the end what happens there. But when they do a cut after a 6-month wait, like now, unless you're in a recession, it's very positive. We're not in a recession right now to it. So again, what is that rate increase? If you do a September cut after a 5 to 12 months kind of a wait. All right. So this is what happens. So let's take a look at September cuts. The last time we have a September cut was 1970. And the following year, from that cut onwards, the market was up 21% after a 5 to 12 month wait. All right. So this is pretty good because 90% of the time it's going to be positive. The only one was really 2001. So we're kind of excited by 12 months away. Remember, I told you volatility midterm, then it starts to recover from there. When you do a cut near all-time highs, which we have just had, all right, 2024, it's kind of interesting because that's never been lower a year down the road. So it kind of encourages that. Now, after rate cuts 3 months later, you can have red, but after 1 year, 1973, you had a bit of a red. 2001, which I told you was a recession. 2007, because of 2008. But other than that, she's pretty positive. So what happens to technology after rate cuts? And we're looking at the 2024 rate cut there. 12 months later, NVIDIA was at 53.9. I'm not going to say it's going to go again because that was the beginning of NVIDIA. All right. So you can see, and the 2019 cut, same thing. You see some large increases there. So it is technology that's going to benefit the most from Fed rate cuts. And they're large cap companies, not the small caps. Not even the mid caps, because they need to borrow more money. Large caps with cash don't need to borrow as much money. So again, if you look at gains of 11% usually happen after you resume a cut. So you had a cut and then you did another cut. So 2024 was one now. So it's roughly about 11%. Just remember, if you're in a recession, then it's negative. Okay, again, subsequent returns. All right. A lot of it, financials are going to benefit a lot from rate cuts. This is why JP Morgan's been doing very, very well. All right. Banking system's going to do well. And also you got bank regulations coming up. So banks do very, very well. Their average gain is around 6.8% once you start having Fed cuts. So now you can see why I targeted technology and financial services there, right? We all come down to this one point and know what you own and why you own it. All right. So again, here we're going to highlight we as a company focus on productivity increases in a company. You can see that through operating margins and goes on innovation. What are they doing different that leads to demand? And then we look for stock buybacks. This is what we believe drives things. And I told you we're in the sixth wave of this innovation cycle. But also, I want to tell you, technology is now mandatory. It's very hard to find somebody who doesn't have technology impacting them somewhere in their lives. Literally, everybody I know has a phone or a cell phone. Literally, everybody that I know has a laptop. Literally, everybody, most of the people that I know either have Netflix or Amazon Prime or orders. So technology is mandatory. And that means that inside of your portfolio, it's the technology one that's mandatory and more innovation that's going to create something. And that's where revenue flows. And we just heard from a really good expert on it, right? Raj Ganguly or B Capital. And he said, we're in a super cycle for AI. And it's just the beginning. And it's going to last 20 years. Could last 20 years. This is a super cycle. That means that you're at the beginning of the cycle and it's just going to mushroom from here. All right. So AI is going to have a huge global impact in the coming years. This is his words, not mine. But you can also see that same thing happening when you're talking about earnings. The number of companies citing AI in the past 10 years has just increased. And AI stock in Goldman Sachs, this is in their Goldman Sachs research, right, has created 29 trillion in annual economic output. That's a huge amount. It's more than the banks are even increasing. So what's happening to AI stocks? So 75% of price returns are based on AI. 79% of earnings growth are based on AI. 62% of earnings before interest rate and taxes growth is due to AI. 90% of capital expenditure is due to AI. What about the non-AI stocks? 23% is due to price return. 20% is earning growth. 30%. 8% is because of CapEx and R&D. So you can see what's driving AI in it. And you can see that in what all the institutions are buying. Institutions are buying all these AI companies that are doing some things, right? And if we look at Apple as an example, I'm not trying to predict anything, but we've covered golden crosses and what that means in technology. And you can just see since June 2024, Apple has now crossed into their, golden cross period. Last time that happened, Apple stocks went up 21%. I don't know if it's going to happen this time to it. And then take a look at AI and what Mark Zuckerberg is doing. He's just launched this Meta Ray-Ban display glasses with a wrist thing on say that controls things. So you basically take your hand, wave it around, and just waving your computer screen that you see in your glasses. It's really, really cool. It's a bit expensive right now, and other companies are coming out with alternatives, but this is going to change the way we do things. Google just joined the 3 trillion club, but let's take a look at Google. All right. What I want you to look at is who is next to joining. Amazon and Facebook and Broadcom. All right. So if anybody's chomping at the bit to join the 3 trillion club, it's probably going to be an Amazon. So kind of see what goes on there. Let me go into defense spending because we're going to get a lot of news now about wars or crime and things like that. I told you the rhetoric is rising up. Even Donald Trump went against Putin now and is now supporting Ukraine. So that just tells you that spending is going to go up. And you've seen this huge increase in defense spending. All right. And so what is that increase? So Donald Trump went into the NATO and he, pulled their, bluff. He said, look, I'm spending 5%. Why don't you spend 5% towards it? And so you're starting to see all these countries trying to boost their spending on defense. All right. Now, what kind of defense? All right. So what does this mean? Right. Well, Germany has to spend, like 233 trillion on it, 182. All right. This is estimates. All right. So the total, this is in billions, by the way. So the estimate is that the projected U.S. spend is going to be about 1.5 trillion over, the next period there. So I don't know the period that they're talking about here, but you can start to see that where is this spending going? It's going in AI. So battlefield, it's not just tanks, jets, and things like that. It's cyberspace and low Earth orbits. It's satellites. All right. So you're going to start to see it. In fact, AI is going to be the biggest beneficiary from defense spending. You're going to see 33% in aerospace, data centers, 11%, homeland, 1%, because those are just cameras, semiconductors, 28%, cybersecurity. So you're going to see this huge boost in AI spending. And what that means is more data centers, because you need to have the power behind it, right? And so you see this huge data center growth going on. AI is going to increase data center growth. So you can see that there's a lot of spending going on here. But what now? We haven't seen a 2% drop in the market since April 2021, right? So we're due for something, not a panic here, right? If you look at Tom Lee, he expects the market to go to 6,900, all right? If you listen to JP Morgan, they said there's a 50% upside, all right, before we can even be compared to the dot-com bubble there. All-time highs in September. If you have an all-time high in September, which we did, what does that mean? It means 80% of the time, you got another 4.7 till the end of the year growth. I've already said that. Goldman Sachs is, they're expecting close to 7,200 next year. Remember, 6,600 now. Okay. And if you look at CNBC, they're forecasting 6,800 from Wells Fargo. This is from Wells Fargo. So you can see all the, I don't know what it's going to be, but also we're kind of like heading in that direction. I kind of concentrate on where there are more larger drops. You can see October tends to have larger drops, but February and then March has larger drops. So if we're looking into the midterm there next year, if anything, the greatest component is probably around about March. All right. You have 145, 2% drops, 56. This is just history talking on that one. We will most likely get a good November and December. All right. I've already explained that. If you get a good period, September to the end of the year is usually, 4% there. If you get a 6-month rally like we have had now, okay, on this side there, 6 months of positive. We had a 30% kind of a gain there. All right. 12 months again, positive there. Now here's what happens when you have
May, June, July, August, and September positive in the S&P 500. All right. So we're most likely going to have a positive September. We're really close to the end there. But what does that mean? Well, it kind of 50-50 for October. All right. But November has been 100% positive. It doesn't mean that it's going to be, but this is just telling you what it has been. And then December, it goes back to 50%. So somewhere in October is a chance to take us something. Remember, I told you window dressing happens, and usually you get that in November there, right? And please don't be afraid of all-time highs. All-time highs usually mean that more all-time highs are coming. All the time, but you can see it here in 2008, but most of the time it does. So what's that seasonality telling us? Summer is usually weak, right? It's surprisingly a little bit better than normal. Fall is usually better. Again, summer is usually weak, but NASDAQ is kind of stronger than fall. But the real strength is usually in the winter months. Remember, midterm. So when we look at midterm, this is the important part of midterms. All right. So just remember that if you look at history on the election cycle in the midterm, we're in a post-election year right now. So we're kind of okay. But then once you get in a midterm, their thinking historically is April the 17th to September 29th. Is the weaker period. It's not guaranteed, but it's kind of skewed because of 1 or 2 years. So this has been our playbook through 2025. Okay, so September, and then you kind of go up. We've told you that 2026 is a weaker period, and then you go into 2027, which is a super good period there. Again, in our thinking, using seasonality, this year is a little bit weaker Q3, right, kind of now, but then Q4 gets stronger, which is what we're stepping into. Next year, sorry, this is midterm year. This is midterm year. We're good here. This is a post-election year, 2026. It goes from Q2 to Q3. But once you take advantage of that, buy the good companies, your 2027 is usually golden there. All right. And if you look at midterm years, this is, if you compare the period of ChatGPT versus Netscape, and so you're trying to put the technology bubble on top of things, you can see that we're tracking it pretty close, ChatGPT versus Netscape. But you can also see that in 1998, you saw a big crash, and that was caused by long-term capital. But then after that, it took off there. One of my big beefs is there's a lot of pessimists out there, very few optimists, but the wrong way around. Double-digit returns in the S&P 500 is 54% of the time. Double-digit negatives are 11% of the time. In NASDAQ, all right, so it's the same in kind of NASDAQ is better. But if you take a step back, you'll see there's a lot more green than red. All right. So again, you're going to be positive most of the time. 73% of the time, market is positive. The story isn't over for the year. History always repeats itself, but each time the price is higher. And we've seen that. So please, pessimists sound smart. They've always got a reason for it to drop, but it's the optimists that make money. And I'm going to tell you from the book, what works on Wall Street. It can be put down to just one phrase in the book. Pessimists sound smart, optimists make money. Legendary investor Jim O'Shaughnessy in the book, What Works on Wall Street. So just remember that. As always, remain calm. Our motto in our company is believe there is good in the world, but for that to happen, you have to be the good. David, thank you very much.
Okay, Rana, thank you very much. That was fantastic. Thank you for doing all of that. Everyone hung in there. I've got my notes, but they're not going to come close to what all the information that you said to everyone today. So a couple things that I have. You looked at getting prepared for some of the fears that are likely to be coming our way, whether that's through the media, the financial press, etc., and that's really going into next year, 2026. You kind of highlighted inflation will probably be something that they're going to grasp onto. And probably really geopolitical events.
Mm-hmm.
We don't know what it could be. It could be also some economic data or economic news, but there's going to be a lot of noise out there to cause 2026 to be volatile. And it's an election year, midterm year. You've mentioned that, and you mentioned that a number of times during the presentation. So key message is be prepared for this, right? Understand what it is. You looked at gold, some interesting data on gold, a 5 sigma event, just how far out it's run historically. And if you look back at history, you could see that coming back down to a different level. So we don't know when, we don't know even for sure, but it's something to keep an eye on. You had some interesting comments, I thought, about the way to think from Larry Ellison. One of them was, you can't do what everyone else is doing and expect to be successful. And he also talked about innovation being important. And my apologies, there was a second point in the middle that I didn't get a chance to write down, if you remember that, of what he said. But it really goes to show, if you're trying to be like the herd and doing everything like everyone else, you're really not going to get anywhere. And his thoughts of how to think, how to conduct yourself is very much in line with what we try and do from a financial services standpoint, right? Not to be like everyone else.
Yeah. The third point was, don't find the errors in conventional wisdom.
That's right. That's right. Yes. Yes, exactly. You looked at the indicators. Fear and greed right now is in the neutral. That's good. Railroad tracks are finally now back into the tracks. It fell. It's at the bottom of it. So that's a positive. Brett is looking good. I thought the interesting point here was the earnings, and you talked about earnings in a couple of moments in the presentation, but you had a chart up showing that the earnings growth expected for the Mag 7 it's decent, right? It's steady, but the 493 S&P stocks, the rest of the market, you're actually starting to see an even greater increase, starting at a lower level, but nonetheless increasing. So just really positive signs that the rest of the market is starting to improve and forecasted to improve from an earnings standpoint. And that's really constructive for the market, because the big Mag 7s kind of are steady, right? With a double-digit earnings growth. Put call ratio, that's something interesting because that's very high. We've talked about that many times internally. We did not get a big gamma event on the September OPEX. October is earnings, but sometimes you can get a lot of October can also, before it starts to move up. Do you, without putting you on the spot though, it's been a while since the market makers have exacted their kind of revenge.
April was the last time.
Are you concerned about if the market stays relatively in the same place here, that the OPEX in October might be a reason for a temporary pullback?
Like I said, there hasn't been a 2% drop for a while.
Right.
Okay. But that 2% will be made out to look like a 10%.
Yes.
All right. So I think that's what they need to try to adjust it. The real fear is what they do next year in the midterm,
okay,
and what scale they brought. So if I had to think of options expiry, all right, I would say the earnings seasons is very strong. That'll carry forward into it. Okay. So there's some support built there. But then after year end, once the companies have gotten their year end results out, they can relax for the first quarter and allow a drop. So if there's a larger drop, I would probably put it at the March kind of OPEX date.
Okay. We'll keep tracking this.
Yeah, it's just a probability. It's not prediction.
Okay. So that's interesting. You looked at Trump 1.0 versus 2.0, how the market is tracking similarly. We look at bad news, good news, right? So you went over, there's a bunch of bad news. Job growth is down in the United States. It's obviously not great in Canada either. Canadian unemployment is pretty bad. It's much higher than in the US.
Much higher than you're told.
Yeah. And that segment of the 25 to 54-year-old group, which is basically the biggest part of the employment segment, is the worst performing, and that's not good. You looked at margin debt increasing quite a bit and then going into a midterm year. That's usually not a good combination. Building permits down, office delinquencies increasing. These aren't good things. New home prices are down. I know in the US just yesterday, I think it was yesterday or the day before, there was a month over month, a big increase in new home purchases. But to your point, I heard somebody familiar with the industry saying, well, it's because home builders are providing so many concessions and lowering prices or eating some of the mortgage rate, providing kind of a subsidy there. So they're really having to lower what they take home or make in order to sell houses. So it's kind of a good news, but not really good news situation. So that's something to keep an eye on. And then, of course, the condo crash here in Canada. You cited that CBC YouTube video, which I'm going to go watch. But that's really, there's several sources that we've talked about. The condo market in Canada and GTA is not just GTA, but is really bad. So there is bad news out there economically. And
you have to face it. Just be real.
Yeah.
Don't run away from it.
You looked at China, industrial output down 5.2%. Investment spending is not great. And really the thing that I'm glad you brought up, which is the demographic situation, it does not get better for China. And, probably a lot of that is the one-child policy they've had for decades. It now starts to catch up. That's something to really watch. It's not ascending like it was over the last 25 years. So, things to take a look at. Good news, though, earnings growth. This is, again, where you're coming back, and it's really being driven by large cap stocks. That's where the earnings are. And you pointed out that revenue growth, first of all, you point out earnings growth. If you chart earnings growth, you can pretty much overlap the stock market return. And then you went back to 1935. This is not recent data you're pulling. So that's really important. So earnings matter. You've said that so many times. Earnings matter. And then also when you start to looking at, I guess, a company, revenue growth.
Yes.
And this would also bode for the stock market, but revenue growth is also going to be the biggest contributor to the stock price, right? So you have, in the short term, no, it could be PE, it could be accelerating earnings, but that revenue growth, if you're not selling your product, your service, your stock's not going to go anywhere. Really, it's quite simple. And so that's one of the things we focus on. And I think, as you mentioned, people should be looking at this. Forget all the other stuff people get concerned. Are there earnings or revenue growth? Focus on that. Interesting way of looking at the rule of 72, kind of inverting it, deciding, well, what does my return have to be to double my money, right? As opposed to looking at the time. And then also you even did it to triple your money. So interesting way of looking at the rule of 72, which is I need to get a certain return in order to.
But you've got to accept the volatility.
But can't accept the volatility.
You got to accept the volatility.
Yes.
And take advantage of the volatility.
That's right. You looked at the year-to-date performance. The leading sectors were companies in technology, communication services, and financials. And that's an area, of course, that we focus in on. We're looking for revenue growth, and those companies have it. All-time highs. You mentioned this a couple times in the presentation. Do not be afraid to invest when the market's at an all-time high. Now, of course, we look at things in the short term to some of the indicators that you looked at, if some stocks are getting delayed, we will trim, but we're not selling. We're not afraid to be investing and holding our positions. And the markets tend to go up. So and actually do better investing at all-time highs. So that's very interesting. Again, it's counterintuitive, and you get a lot of fear out there in the media worrying about, because the market's at an all-time high, somehow it has to go down significantly. This is a bad thing. In fact, it's a good thing. You looked at also the estimates in the United States for GDP are going up. All this talk about tariffs and there's going to be a recession and inflation, GDP is going up. So that's hard data, right? It's not fear. You looked at the fact that rate cuts are coming, and you had a lot of data backing up what happens to the market after the Fed starts cutting rates, and it's positive. And tech stocks, large cap tech stocks, 12 months later are the best performing category. So, things to look for. And then when you talked about technology and we're in an AI super cycle, and you cited so many different pieces of evidence. It's revenue growth, it's capital spending, right? It's earnings. There's so much being poured into it. It is, and then showing the difference between an NVIDIA and a Cisco, because I thought that was interesting, because I was around for that early 2000s and that whole tech bubble. But the thing that was missing was earnings, and we have earnings, and that's not disputable. You looked at defense spending and the increase that NATO is committed to, 1.5 trillion US. And as you pointed out, this isn't all going to, traditional planes and tanks and bombs. It's going to infrastructure, AI infrastructure, and things around that, which is another catalyst, another input for revenue for companies that are producing and in the AI space. So I think it's hard to ignore this, and probably you shouldn't be, the AI spending is real and it's not slowing down. It seems to be accelerating everywhere around us. Then you had some other stats. We're looking at seasonality. If there's an all-time high in September, 80% of the time, the market's up around 4.7%. There's some other data that shows it around 5%. This is a good thing. And then you looked at, I think what I always like, the 4-year presidential cycle seasonality. It seems to be tracking, and we look at that. So next year, this midterm year, we are over the next couple months, Rana, for your next 3 presentations will be the last of the year.
Yeah.
And I think we're going to be really focused as a company on positioning our portfolios for 2026 midterm year. And
we're going to be pounding the table on that one.
We'll be pounding the table. Yeah. And it's really, really important how to handle that. And so, that is something. But the nice part, I tell people that I speak to, I had a couple conversations last night. Once we get probably somewhere in the summer, and we'll be watching when the pullbacks happen, but that period from the election until the next end of April, that's kind of that golden period.
Yeah.
And deploying capital, just before the election, when the markets may be down again and pessimism is at a peak, that's when you want to kind of take advantage of that, knowing that period. The market's never been down, I think, since 1950 in a post-midterm election year, from post to the April of the
year. I agree.
Right? It's, think about 2022, how horrible a market that was. That was a really, really nasty market. In fact, I think the S&P was down something like 23, 24%. I mean, that's not a usual year.
October 12th was the low.
And yeah, exactly. And the market was higher between October 12th and to the end of April 2023. Even when things look really bleak.
With 9% inflation.
Pardon me?
With 9% inflation.
Exactly. Interest rates were being cranked up all through this period. It was so you as you said, and you pointed out in the end, sounding like a pessimism. You sound smart being pessimistic, right? But it's the optimists that make money. And so we have to look at probabilities. We have to look at the facts. We look at history. We don't get caught up in trying to sound smart and saying this is coming to an end and watch out for this. We have to look at, what's going on and conduct ourselves in that manner, and not too high, not too low. So I thought this was a really good presentation. And it covered some interesting areas, and also very important reminders, right, of what to ignore, what to be prepared, what's coming, whether that's fear news or other things. We want to be able to look through.
I don't look at it as fear news. I look at it as regions for potential opportunity. And that's how I look at fear.
Right.
It gives me a chance to have an opportunity.
That is true. That's actually the best way to look at it, right? Mm-hmm. That is the best way to look at it. So great presentation. Let's see what we have here for any questions or comments, and I'll go back up here. Okay, Chris had something here near the beginning. Chris, was good to see you last night. The AI trade appears to be carrying the markets, but I have two concerns. I'm seeing a number of job losses attributed to AI enhancements, but a bigger fear of future job losses. I saw the effect of lack of confidence by consumers in 2008 and wanted to hear your thoughts on this. The second concern is income attributed to AI justifying the huge capital expenditures. Do you think that the return on investment on AI by the top 10 companies justify it? There's a lot there.